Intuit stock has dropped from the all-time high of $813 all the way to the recent low of $350. That is more than 57% drop. What is going on? What's up, homie? This is Howie. I'm a principal AI engineer with a PhD in physics. Welcome back to HowieVerse, where we treat investing with data-driven mentality. In this video, I'm going to show you the price action of Intuit stock. The second segment, we're going to move on to the fundamental of the company. And in the third segment, I'm going to show you something that's going to make you sleep better at night if you own Intuit stock. First, this is the Intuit price action. And according to this chart, the first thing that I look at is this bull flag right here. And you got the pole over here. And then there is this flag that is consolidating over here. And you can see this tags the parallel channel that is going down, going up, and then we are currently at the lower level of the parallel channel over here. If you look at the lower side of the parallel channel, in particular this candle over here that is on Friday 27 March 2026, what I'm going to predict in the short term is that you see there is a close level here and then all the way to the lowest of the candle is about 1.67, and that is something that I'm looking at for the short term for a swing trade. And if I go on the reward side, let's just assume that on Monday is going to go open around that range. And if I draw that, that is about 9 to 10% upside. So in terms of the sacrifice of the lower side, it's about 1.6%. And then the upside is about 10%. That is about 1 to 10% risk to reward ratio for a swing trade, because in the short term I believe that this eventually going to tag the upper level of the parallel channel. Not only that, for the longer term, medium term, is what happening is that I believe that the stock is going to go up to this downsloping channel. So if we look at this, is that this downsloping trend line is tagging the all-time high right here, and then it also tagged the high over here before it drops down precipitously, this nasty drop, right? So if you look at the short term, likely that is going to tag the upper side of the parallel channel, and eventually it is going to break through and is going to tag this downsloping parallel channel. So that is the medium term. What is the longer term? In my humble opinion, the longer term is that this stock, Intuit stock, has already bottomed out at around this price, $352. And the reason why is that if you look at this over here, right, what do you got? You got a really strong support. And where is this dated to? If you look carefully, there is not one but two support indicator. There is this horizontal line, and there is also this upper slope, right? And if we look at the history, this is tagging all the way in 2022, not one time, but twice. This actually tried to pierce down, but it didn't happen. The buyers swoop in, and then it retake the stock to the upside. Now, this downsloping this downsloping channel over here, if we look at it, it dated back all the way to March 2020. And you know what's happening in March 2020. And with that reason, I think this two line or two indicator has made the Intuit stock bottom out. Not only that, if we look at the longer term where it's going into 2027, we have another line that is meeting over here, right? This horizontal line, and also this another upper sloping trend line. And around the end of 2026 and the beginning of 2027 over here, we got this convergence of four indicators: this downsloping trend line, this upsloping trend line, another upsloping trend line, and this horizontal line. This make me believe that $352 is the bottom of the stock. Not only that we have this bottom right here, but it could also be well in the end of the year or the beginning of the next year is going to tag this line. So my prediction, it's likely not happen, and this is not financial advice at all. This is just for educational purpose. The stock is going to tag the upper level of this parallel channel for the short term. For the medium term is going to go here, and for the longer term, maybe in the end of 2026 to the beginning of 2027, is going to go something like this, right? And if you know that we have this wedge pattern here, and the most likely where it's gonna go is gonna go up. Now let's look at the second segment of the video, which is we're going to look into the fundamental of the company. And Intuit actually owns TurboTax, Credit Karma, QuickBooks, and MailChimp. With that, let's look at the recent quarterly report, which is the second quarter result. And here's the most important thing in this report, that if you only take away this is the one. So it says we are defining a new category at the intersection of AI and human intelligence, one that deliver autonomous, done for you experience. They start the traditional assisted tech segment and provides mid-market enterprise with the native ERP platform they need to win. We are accelerating execution and innovation to deliver even greater impact for our customer. So, what has the stock been going on for the last few months, from the all-time high to the recent drop of 57%, is that the investor are afraid that the AI is going to take over this platform. So we no longer need Intuit at all. We no longer need their products. The AI is going to do it instead of Intuit. That was the fear that makes Intuit stock drop so precipitously. However, with this, the comment of the CEO of Intuit says, not only that we're integrating of the AI, and not only that you don't have the fear anymore of the AI is going to make Intuit irrelevant, but with this integration is actually making Intuit products more relevant with AI. So the AI fear, in my opinion, because of this, they are integrating AI into their ecosystem that is going to make their software more powerful, more valuable to the customer because of this AI and human intelligence integration. So let's look at the financial highlights. The financial highlights, the segment revenue grew from 17 to 23%, and the earnings grew for the non-GAAP is 25%. That is down here. Looking for guidance, let's look at the guidance, right? The revenue is only gonna go up about 12 to 13%, which we see it was at 20, like 17 to 23%, right, for each of the segment. So I believe the CEO or the company is sandbagging this so that it is easy for them to beat the revenue. And not only that, for the gap for the diluted earning per share, we saw 25% increase. Here, they only expected to grow for the 2026 is 13 to 15%. Again, sandbagging. And the company also reiterate full fiscal year of 2026 segment revenue guidance. For the global solution, it's 14 to 15%. This is the big chunk of the market. And for the consumer, it says only high single digit, 8 to 9%, which is underwhelming. Nevertheless, I think again they are sandbagging this. For the income statement, I would like to see more on the 6 months ended because the 3 months ended has less average meaning to it. And for the 6 month ended, it's better average because Intuit is more like a cyclical company. Some months they are going to make a lot of money, and then the other months they are going to make average, right? So this is why having a longer average is better than if you just look at the 3 months. So let's look at the net revenue. The net revenue grow 20%, which is really good, which is what we saw. And that is for the service. And for the product is growing about 5%. It's underwhelming, but it's a small fraction of their revenue. Overall, they are growing 18%. So if you combine the service and the product together. Now, for the cost of service of revenue, this is growing only 9%, which is good, right? We do not want to see the costs that accelerate even more than what they're making in the revenue. So 18% in the revenue and 9% in the cost is good. Now their selling and marketing is higher, is at 14%, which is really close to 18%. We want to see this lower. And also for the research and development is really close to 18%. However, this is what I think that the company using this R&D to put into the AI integration, which is going to be good in the future. Also for the general and administrative SG&A is only 5%, which is really good. There's nothing to worry about that there. Okay, now overall for the net income is growing 70.5%. That is a very, very solid growth. Nevertheless, one of the things that I do not like is that put down a comment right here, the net margin is only 13%. So it doesn't really have a lot of purchasing power in terms of the net income. The thing is that if something swings the other way, for example, like the cost is going up, the bottom line is going to be punished. Now we're looking at the balance sheet. The balance sheet says that the cash is at $2.9 billion. And if we look at the current liability, they have $2.4 billion to pay, which is nothing burger. It's just basically they have the cash to pay off all of the short-term liabilities. And for these current liabilities before fund payables, this just mean that the tax return that is actually going back to the customer from the tax revenue, they are holding it for them. We have $4.4 billion on hold. Nevertheless, if you look at the asset segment of that, we have about $7.2 billion. It's just that the increase in this current liabilities of the fund is more concerning, but we have to see in the future if this gets worse. And for the long-term debt, it's almost nothing to worry about for now. It's about $5.4 billion, and it roughly is going to take 2.5 years to pay off all the debt based on the net income. Yes, I know we're supposed to use the free cash flow, but I'm just being lazy here using the net income 2.5 years. There you go. Now, what we are gonna be looking at is definitely going to make you sleep better at night if you own Intuit stock. And what we're gonna look at is the revenue of the Intuit for the last 10 years. The revenue of Intuit for the last 10 years, if you start at $4 billion, now the company has been making $20 billion. That is 500% increase in the revenue itself. Now, let's look at the EPS. The EPS tells the same story. For the last 10 years, the EPS has this upward trajectory where the earnings per share is at 219, now is at 15. So that is almost 10x of the profit that is made by Intuit. So profit, the bottom line is essentially what drive the stock. And if the profit goes up by 10x, most likely the stock is going up by 10x. This is usually how it goes. In conclusion, technical wise, it shows us that the stock of Intuit is going to go up soon. And also for the fundamental wise, we look at the revenue and also the bottom line, both are growing. So not only that we have Intuit is a solid company, but it is also a growing and expanding company. With the AI integration, I might have a bias here that the acceleration of the revenue and also for the profit is going to go up even more. I hope this video has given you the educational value that you're here for. If that's the case, please consider hitting the like button down below. If you like more analysis like this, check out the pinned comment down below. I'll see you next time.